Hello, everybody. Kirk Spano and Scott Shooter Henderson with our major markets update for the weekend. Scott, what the
Here's
hell is
everybody.
going on?
Not much, actually. It's,
Okay.
I feel like I'm just stuck after the last couple of weeks, but I think it's about ready to change, though.
Just tell me, what are you seeing? You heard what I had to say in the last webinar in the macro dashes. Are you starting to see the market support what I said, that we may see a correction start in the next couple of weeks?
That's consistent with seasonality. The problem is we're pushing quite a little bit here, and I'm just going to start with the dollar and sort of tee off of what you were talking about.
All right.
This to me does not look bearish, even though the count is telling me to. Just because we have a nice divergence in price down here, good base. Historically, same look here, and we had this huge rally up. So I think you're right. I think there's a chance the dollar turns north, and that will bring down the indices. So,
okay, will it last long, or will it just be a pause that refreshes?
Well, look at the range of this. Here, let me just put a little box up here. So we were about here for about that long. We could go something like this for about that long. So it could run to January 25.
Which is one of the things we've talked about in the past.
Simplest thing in the world. I call it equality. All right, let's jump to the S&P. Now, this is getting challenging because we are confirming on the weekly here. So, this is just my mentoring, so what does that mean? It's that we're going to have at least one more higher high in price. Now, the difficulty here is this doesn't look done to me. It hasn't put in a top down here in RSI. So, we could very well push to that 3, and that 3 could extend. Now, note that right now we see this as a leading diagonal. But like I've mentioned before, there really is not much that's going to prohibit us from this 3 becoming the longest wave and probably push up into the 560, 570 range. With this, they're buying every dip, mini dip. And the blocks are just getting bigger. Instead of 25 or 30,000 contracts, they're up at 50 and 100.
Right. So we're starting to see a lot of options activity. The skew is high right now. So the skew indicates tail risk.
Yeah. We're going to have a catalyst, I think, here for us to kill it. That's the challenging part. The question is how fast it comes off too. Because, note how the depth of that retrace is, if it is a leading diagonal,
So let's pretend I know what I'm talking about, and Jerome Powell is a bit mean in 2 weeks. What could a correction look like between the Fed meetings if Powell goes from mean to not so mean in March, not so mean in May? What would a 6-week or month-long correction look like?
Well, looking at that, because I think that would come in right around where our minor wave 3 is. Just taking a regular fib tool, 50% back is 463, right around where that target is. Right. Our support here, January 22, which was resistance at 466, is a good spot. We got no back test. So that needs to happen. That back test, we need to get something down there, and it would be better if we came down to 449 for the longer time upside.
And as a percentage of the market, that's a little over 10% down.
Yeah. Now, if you look back in the tape, we really don't, in the last 5 years, we don't have this kind of push in the S&P. Now that, this could all be a result of COVID because of so much weight that started hitting the stocks. And now everybody realizes, hey, earnings really weren't that bad. They actually were decent, and that's one thing I noticed about UBase. If you took 30% of the stocks, just assuming we have this large box of S&P top 100 stocks, and you bought calls on each of them at strike, you'd be up about 80% right now.
Right. I just showed that certain large cap stocks, really your 100 billion plus stocks, have a combination of being overbought and overvalued against their earnings. That means for the stock market to keep going up, we need to see a continued broadening of what is attracting capital.
Yep.
We know that there's about $2 trillion extra dollars on the sidelines compared to what is normally on the sidelines. So if $2 trillion finds a home, my thought would be that you want to continue to buy every dip. But you also want to find some of the undervalued things that people might decide to finally invest in. That means that the small caps, some of them at least will do better, right? So because we've seen some strength in IWM.
Yeah. Now, actually, right now I've got a decent bull. It's still an ABC, but there's nothing that would prohibit this from becoming a flat and head towards the highs around 239 at this point.
Okay.
Actually, I'm surprised that we haven't come off and put in something lower down here around the 142 range, just because I know the weight's there. If you look at the P&Ls, I mean, they really don't look that good. I mean, it's just what we're seeing is breadth expanding is, capital, in my view, naturally has to find a home. So, if we go look at the NASDAQ, is if you're going to pull capital off of the market because you're seeing gains, and you're going to reinvest, are you going to reinvest here at 445 NASDAQ, or are you going to reinvest here at a 205 Russell? I would think, because we're not at all-time highs, that would be where I would put a percentage of my capital, simply for that reason alone. But one thing, the Dow is really looking a lot like what the S&P looks like. So we've got this leading diagonal again. And, the thing is we need the SPY to continue. We need the NASDAQ to continue. And we need the Dow to continue for us to build higher in the S&P. Otherwise, we're going to have a decent drawdown. And that's really where my concern is that we have some kind of an event. I think in the back of my mind, Powell, I think the smartest thing he could do is speed the run-up, not raise rates. Speed the run-up off, because we have room to get it done. And then
you mean more QT?
Yep.
Higher QT.
Yep. I think it would be the smartest thing you could do here, because we got the job growth. I mean, we got the earnings coming in the major companies. I mean, it would be a very intelligent move for him to build the coffers up right now, because we do have the room, So now I don't know exactly, I was looking at that, trying to find a point in history where I could reference it, and I couldn't find it. So, they typically stay to their dot plot. But at the same time, if the economy is in trouble, quote unquote, where they need to bring in quantitative easing, I think we would start seeing more signs at this point from the different Fed members. And we're not. So that's, my thought is we're in a great place, and they don't know how big as you look at history, the financial crises keep getting bigger, versus the Great Recession versus the Great Depression. I mean, the Great Recession was a bigger dollar figure, and I guess that's what I mean by bigger. So, it's going to require bigger coffers to address the issues when they come. And, we're not seeing the real estate. I mean, even though the vacancies are high on the retail space, in the office space, it's not horrible. So I see some tightening there, but at the same time, in my area, they're projecting a 6 to a 9% growth in the value of property. So again, we're just getting back to that new normal. That's sort of my thought.
Okay. Well, okay. So I'll give you a couple of my thoughts. Good. First off, the Fed can't increase quantitative tightening because the repo market is already seeing some stress.
Good point.
But that means that maybe what I talked about a few minutes ago in the other program in the macro dashes is that maybe in 2 weeks they put off cutting the quantitative tightening. So maybe they leave the quantitative tightening at where it is versus starting to wind it down, which is what everybody kind of thought, right? So it jives with what you're saying. I don't think they can increase the quantitative tightening, but they can delay when they start cutting it.
Yeah.
So I agree with that. As far as real estate goes, there's a number of heads there. The commercial real estate, actually vacancies are at the highest ever. So if the office real estate really has a problem, and you have 11% of the people working right now are completely remote, about another 20% that are hybrid, and 70% of the people still go to work, but a lot of them are factory floor or stores or, things that can't be done remotely. So what's going to happen with the 11% who are remote and the 20% that are hybrid? I think you're going to see a number of the remotes become hybrid, because I think that management wants that. There's not many people who I think can even justify being 100% remote. So I think that you will see some changes there, but it's not going to change the office space equation much, because if you're only coming into the office once or twice a week, for team meetings or whatever, they don't really need more office space, right? Because you share a cubicle now, and you end up going back and forth to the conference rooms and the meeting rooms. So it's easy to rearrange floor space, right? So the commercial real estate really is a problem. But it's, like I said, only about, in the past, I've talked about the size of this market. It's only about 1/3 of the residential market, or 1/6 of the residential market. So you can't really compare this to the financial crisis. This is a 500. Yeah, it's a $500 billion to $1 trillion problem. That's a drop in the bucket for the Federal Reserve. They'll deal with it, and they can deal with it by cutting the quantitative tightening at some point, extending the special facility that ends next week, right, or in 2 weeks, and then flatten out the yield curve. And I think if they just flatten out the yield curve, they get the short end down to under 4. But I think in the long term it has to be closer to 3 because of the treasury rates on the debt. But in the short term, they really only need to flatten it.
Yeah.
And once they flatten it, the banks are and they have the special facility, the banks are fine. And that's why I think that this market has legs into next year. When the tax code reverts to mostly Obama era in 2026, that actually could be a really good year for the budget, right? Because you might have 2 up years in the market, then everybody gets taxed at the higher rate. So you might not see a problem with the deficit and the debt again until later in the decade, which is when the last boomers get on Medicare. A lot of things come into a head, last few years of the decade. In the short run, you're still with buy the dips though, because the next couple of years look pretty good.
I would agree with that. I'm just trying to, I come back whenever we're extended, this should have been a divergent high in RSI here. This.
All right.
Okay. And whenever that occurs in an indice, I'm always going back trying to determine, well, what's causing that? And is it going to continue? Or do we have a decent flush coming from that event? And that's what I'm trying to see. So the reason I brought up jobs and the real estate market is because that's a demeanor change, and even Tesla's, I use that as an example. It looks to me like a lot of the EV companies are going to go belly up now. I mean, we're actually starting to hear news about that. But it's where what I see is that there's almost a rotation to risk where it shouldn't be going right now. I mean, like, I can see the rotation into crypto. Yeah, I can see that. And honestly, a lot of big players, MicroStrategies as an example, got the guys up almost $2 billion at this point from his bets. Yeah. And, looking at the overall market and where we want to be, I think it's going to be very selective. But again, we are back to the rinse and repeat. They have specific names. They're pumping it. They're rotating out of that name. And then they're going to what came or drew back a little bit. And then they're pumping that. And then they're selling it. They're rolling to something else. And there's literally like 24 names that they're typically in on a week-to-week basis, and then they're out. And the problem with that is that the individual names, they do really well, and boom, they give at least 50% back. And that's a very challenging market, even for a guy like me, because you just don't want to stay in them that. That's the tough part, because there's no reason to buy the S&P right now. None. There's no technical tool that tells us it's a buy here. Okay. Now on a back test, we get down, to the 382 fib, at that point you might want to start to scale. But, the other thing that's flipped over this week, and I'm hesitant because I don't know that the issue with the Fed is resolved on whether they're going to cut rates in the foreseeable, next quarter, 2 quarters. Just because I don't, jobs are good, earnings were good, they're going to be, that carries a lot of weight in their decision process. We need a catalyst. However, right now, the FOMO, just the minor news that we had last week, that, and I think it was Bostic who said it, was that, it might be appropriate to cut rates in the summer. That was the comment, something to that effect. And now here we are with TLT, now giving me a new primary wave trigger at 92. Now I'm just a half position size hit at 94.12. So unless we take out this candle, we're probably heading towards that 1 around 98. Right. So
So here is where I would tell people that I just avoid TLT right now because it's in the middle of the market.
Yeah.
If TLT flushes, into the middle, the low 80s, I'd probably buy it. But around here, I'm just ignoring it. I just don't think there's enough movement for it to be
Well, I was
important.
just meaning the demeanor change. I was
And
focusing on that
I
part.
get it, but to me, it's a hard decision. So I want to avoid hard decisions.
I don't disagree with that. I mean, quite simply, we close below whatever the low is of that candle, and I would cover it if I was long, period. Yeah. I mean, I'd just be out. It probably would be a decent chase because if the FOMC is positive, we're probably going to run right back up to 98 pretty quick, I would think. So, all right, let's jump over to crypto because I think everybody wants to see that.
Well, Bitcoin.
Yeah, that basically is it. One heck of a candle. Now, this is where we had it the last time. Same breath. And we basically came back and gave the whole candle back, both events over here. So there's a good possibility we do that. Count's pushing. I'm getting a 67,937 for our target one on our primary wave 3. We'll get an intermediate wave in there first around 66.5. And that back test should take us down to 56, which was answering your question earlier in the week about, hey, when can I buy more Bitcoin? 56 is a good price.
Yeah.
Okay. And then I'm going to jump back, unless there's anything else you want me to cover in crypto.
No, the one thing I'll say about Bitcoin is that, my short-term target was 85,000, which is what you're showing now. But I really do think that by next year, it's over 100 grand. And I think it's 300,000 sometime this decade. Yeah. So the idea of selling crypto, not crypto. I think most cryptos are going to zero. I think there's about a dozen.
Or a breakout.
Yeah, I think there are about a dozen cryptos that survive as software as a service proxies. But Bitcoin is your digital gold, and I think that ultimately to expand to that $5 to $10 trillion, it's got a lot higher to go. So I don't know that anybody should really be selling Bitcoin on these peaks. I just think that you stop investing for a while, and then when you get a pullback, if you have extra money, then you buy more. Again, it goes back to my idea: don't short great stuff, and Bitcoin's great. Yeah. So if it gets ahead of itself, you just stop buying it.
And this is off base as first question. I mean, so tech, okay, as a percentage of a portfolio, what percentage do you think? I mean, just sector. We know tech is growing; it's going to continue to grow. What would you think would be a good percentage for a person to have in tech?
Around half.
Okay. Now, let's jump over and flip to crypto. Look at crypto as a sector. From an investor standpoint, how much do you think an investor should have invested in crypto using that same mindset?
An investor like me or an investor like everybody else?
All of the above. Just a collective.
So I will tell you my personal portfolio is a dozen small caps plus Square and Palantir. And then about a quarter of my money in Bitcoin.
So you're going around on the edges. So
I've got a dozen stocks plus Bitcoin, right? And that's me. I'm trying to hit grand slams. Bitcoin, I bought Marathon a few weeks ago, like I talked about, and I should have put out a trade alert, but for me, I was just going to flip it, and now I'm starting to believe. But I think we are at the point we're in a whole new hype cycle. Yeah. And this is a big, huge adoption hype cycle. So this is the second half of the Gartner curve. It's just going to be steeper because it's a new asset class. And that's what people have to wrap their heads around. It's a new asset class.
There's a lot of chatter around derivatives.
Right. It's going to be $5 to $10 trillion. And with Marathon, I just think they're the best miner. And they have a backup business, right? They have a plan B. And if you follow me, I always look for what's plan B. And so Marathon has plan B as based on an independent energy producer. So I take a look at Marathon. And I'm like, well, after this big run up, I wouldn't buy it, but it pulls back 20 or 30%. I think that's when I would send out a trade alert to everybody and say it's an investment now, not just a trade. As far as most cryptos, I think they're going to zero. I think there's a dozen survivors, give or take, as a regulated guy. So here's what I would say as an investment advisor, right? Because I have regulators who, are looking at me like, but in my client portfolios, we have a single digit amount in Bitcoin, under 10%, but over between 5 and 10% really. And that's because I can't get in trouble for that. So I've sent out 6 emails about Bitcoin, trying to get people to at least talk about it because they might want to buy more on the side. I just can't do it as a regulated guy. Personally, I own a quarter of my portfolio in Bitcoin, and it's really worked out. So I take a look at it that way. Now, in a regulated portfolio, right, as an investment advisor, put a half of your money in tech, and they split up tech and communications, right? So like Google and Facebook are in the communications now. If you take a look at XLC and XLK, the tech and the communications, and you add up their portion of total market cap, it's around half. So it's okay to have half your money in tech and communications. It's okay because that is actually basically index similar. And I would tell people that I almost think that you should still overweight that. But if you take a look at your personal portfolio, folks, and you like, well, I'm 30% in tech and communications, that's low. That's low against the index. It's very low. So you really do want to be at half. If you want to make what the S&P 500 is making, you need half of your money in tech and communications, and communications mainly being Facebook and Google. So what's the solution? You buy QQQ. QQQ is the perfect index. It's the one that always wins. So, I think that QQQ is what most people should have as their core holding, up to half of their money. Or if you want to overweight, 8 or 10 or 12 stocks, then you bring your QQQ down, and then you overweight Microsoft and Apple and whatever it is you want. So, I mean, I think that's an important lesson, actually. I don't think people always understand what the breakdown is in the S&P 500. So if you go to the S&P 500 website, you can see what of which each sector comprises. And, that's just the reality is you don't want to be overweight utilities. You don't want to be overweight materials. You don't want to be overweight staples. All those things you should be underweight, and then you should overweight the tech and the communications. And at the moment, this is the one chart I'd like you to put up is XLE, the energy. I think that the energy equation right now, the combination of controls on oil supply leading into the flattening of the shale growth, leading into all sorts of tax breaks for biofuels and carbon capture. I really think XLE is about to break out. I don't know, like imminently, but soon, by summer maybe.
Yeah, I mean the difficulty with it is you really got to catch it on the twos because it's not 50% yet, but it's pretty close to 50% of the move already.
Yeah,
because it doesn't have this. This doesn't happen. It's usually this kind of a grind.
So we've been we've been chopping sideways for a year and a half.
April of 2022.
So either there's a breakout or a breakdown, and I don't think it's a breakdown.
I don't think it's a breakdown either. I don't think there's too much of a supply going kind of thing.
Yeah. By the way, I'll just remind people again, and again, if you want to come up to Fort Worth, Shooter, I'll be in Fort Worth for Super Doug, which is a hard energy event that focuses on shale. And that is May 14th to the 16th, something like that.
Yeah, so I put it on my calendar. At this point, I have no conflicts. Okay, now the ETF I wanted to cover today was ARKW.
The only ARK fund worth owning.
The monthly chart just looks really good here.
Yeah.
50% back is up at 123 from where we are. So, even if we get a back test at this point, it should only bring us back down to about 83. It looks positive to the upside. And that's pretty much what I've got.
Okay. There's a couple questions. Somebody says, what if I don't have QQQ in my 401k? And somebody else says, I have the S&P 500 growth index. I think that, yeah, you have to take a look at what is the most similar to QQQ in your 401k. So like I offer QQQ in the 401k that I have at companies. However, I also offer most of the sector funds too, and a gold fund. So I have a pretty, advisory friendly 401k plan out there. The other one is the S&P 500 growth at a reasonable price index. Not a lot of reason to ever buy SPY because there are, if this was pharma, they would be biosimilars. There are similar ETFs to SPY, but that are better. They're a little bit lower risk and they perform a little bit better. QQQ is the best one, but the S&P 500 growth index is good. The growth at a reasonable price ETF is good. You just have to find in your 401k what is your best option. And honestly, if you just look at the 5-year and 10-year track records of the ETFs, you pretty much can just pick your winners from that in most cases. Don't look so much at the 1 and 3 years, but the 5 and 10-year winners pretty much are going to continue. And if you can buy those on dips, on 401k, you're dollar cost averaging. So, you just focus on the ones that win the most over the longest period of time. And if you have the ability to trade a little bit more, there's some other things you can do, like I have my Blue Mound growth portfolio, which is basically global trends ETF. And you can go that way. So that's just what I would say is if you got a 401k, yeah, the S&P 500 growth index is a pretty good one to buy. And yeah, realize that half of the S&P 500 is growth in communications, technology and communications. That's your portfolio should reflect that. Those are the big winners. Buy the dip. The dip's probably coming. Trim your mega caps, sell some covered calls, and don't sell things that are undervalued, right? Because eventually that'll work out. But there are times when you just stop buying temporarily. So anything else, Shooter?
Nope, not at the moment. Just sort of waiting for setups to come. I think it's going to be quiet until we get some pullbacks.
And remember, the reason that the ARKW fund is the one worth owning is because it's 10% Bitcoin and owns several stocks that are heavy in Bitcoin. So that's your backdoor play into Bitcoin.
Awesome sauce.
All right, everybody. Take care.
All right. Feel better, buddy.
Thanks for having me. Blowing my nose a lot.